If you own silver, you've probably heard the phrase gold-silver ratio thrown around, usually alongside some claim about whether now is a good time to buy, sell, or trade one metal for the other. As of early to mid-August 2026, that ratio has been sitting right around 67, confirmed across multiple pricing services in the 66.9 to 67.1 range. If you're holding a meaningful amount of physical silver, say 100 ounces, understanding what that number actually means, and just as importantly, what it doesn't mean, is worth 10 minutes of your time. Before we get into it, the note I include in every video on this channel: nothing here is a recommendation to buy, sell, trade, or hold anything. The gold-silver ratio gets talked about constantly in ways that blur the line between historical fact and prediction, and I want to be very careful in this video to keep those two things separate. We're going to walk through what the ratio actually is, what it's done historically, and where it stands right now, as of the dates I'll mention specifically. What you do with that information is a decision for you and a licensed financial advisor, not for a video explaining a ratio. And let's start with the basics, and then we'll build up to why 100 ounces of silver looks the way it does through this particular lens. What the gold-silver ratio actually is, the gold-silver ratio is about as simple a calculation as you'll find in the precious metals world. You take the current price of 1 ounce of gold, and you divide it by the current price of 1 ounce of silver. The result tells you how many ounces of silver it would take to equal the value of 1 ounce of gold. As of August 10th, 2026, gold was trading at roughly $4,359.96 an ounce, and silver at roughly $65.11 an ounce. Divide those two numbers, and you get a ratio of almost exactly 67. That means, at that specific moment, it would have taken about 67 ounces of silver to equal the value of a single ounce of gold. That's the entire concept. It's not a mysterious or complicated formula. It's just a snapshot comparison between two prices that both move independently, and the ratio itself moves as a result of however those two prices shift relative to each other. Where this gets more interesting is in how much that ratio has moved over time, and in understanding where 67 actually sits within its own longer history. Where 67 sits historically, here's where I want to slow down and be precise, because this is a number that gets thrown around loosely in a lot of financial content, and precision matters. Looking back at annual averages since 1971, the mean gold-silver ratio has been approximately 60.5. That's a long-run historical average, built for more than 5 decades of data. Some analysts describe a slightly wider band, somewhere around 60 to 65, as the more general normal range the ratio has tended to gravitate toward over time, though 60.5 is the more precise long-run mean figure. A reading of 67, then, sits modestly above that long-run average, not dramatically above it, and nowhere close to the extreme levels the ratio has reached during past periods of stress. To give you some sense of scale, over the past 52 weeks alone, the ratio has ranged all the way from 46.3 up to 88.9. That's an enormous range, and 67 sits roughly in the middle of it, closer to the upper middle than to either extreme. It's also worth knowing what the truly extreme ends of this ratio's history have looked like. Going back over the past 20 years, the ratio touched a high of about 123 in March of 2020, during the early shock of the pandemic, when gold vastly outperformed silver as investors rushed toward the most traditional safe haven asset available. On the other end, it touched a low of roughly 31 back in April of 2011, during a period when silver was rallying dramatically relative to gold. Measured against either of those historical extremes, a reading of 67 looks fairly unremarkable. Sitting well within the range, the ratio has occupied across most of its history rather than anywhere near either tail. Correcting a common misconception, what 80 actually represents, there's a specific claim that circulates a lot in precious metals content, and it's worth addressing directly, because it's easy to get the framing slightly wrong. You'll often hear that once the ratio crosses roughly 80, that's historically been treated as a signal that silver is significantly undervalued relative to gold, a threshold some analysts and traders have used to describe genuinely extreme divergence between the two metals. At a reading of 67, we are not at that threshold. We're above the long-run 60.5 average, meaningfully so, but we remain below that commonly cited 80 level that's historically been associated with the more extreme end of silver's relative undervaluation. This distinction matters, because it would be inaccurate to describe today's ratio as sitting in that historically extreme cheap silver zone. It's elevated relative to the long-run average, but it isn't at the kind of outlier level the ratio has reached during past periods of genuine dislocation between the two metals, like 2020's spike above 120. I want to be clear about why this distinction matters practically. A lot of content built around the gold-silver ratio tends to round up the nuance and simply say the ratio is high. That historically means silver is cheap, buy silver. That framing skips over an important piece of context. How high, relative to what benchmark, and how does today's specific reading compare to the truly extreme historical episodes where that kind of interpretation has more commonly been applied? A ratio of 67 is a genuinely different situation than a ratio of 90 or 100, even though both technically sit above average. How we got here. The extraordinary path through 2025 and into 2026. Understanding today's ratio is a lot more useful if you understand the path that got us here, because it's been an unusually dramatic one, even by this market's standards. Through 2025, silver had an extraordinary year. Silver's price rose by roughly 145% over the course of the year, compared to gold's still substantial but comparatively smaller gain of around 64%. When one metal outpaces the other by that much, the ratio between them moves dramatically, and that's exactly what happened. Back in April of 2025, the gold-silver ratio was sitting around 105, meaning it took roughly 105 ounces of silver to equal 1 ounce of gold, a reading that itself sat well above even the more extreme historical bands we just discussed. From that point, as silver's rally accelerated and it began sharply outpacing gold, the ratio compressed dramatically. By silver's peak, when it briefly traded above $120 an ounce in very early 2026, the ratio had fallen all the way toward the mid-40s, an extraordinary swing from where it had been just months earlier. Since that peak, both metals have pulled back from their highest levels, and the ratio has settled back into roughly the high 50s to high 60s range through the first half of 2026, landing at today's reading of approximately 67. Walking through that path matters because it shows just how much movement has happened underneath today's seemingly moderate number. A ratio of 67 today doesn't mean the market has been calm. It means that after an extraordinarily volatile stretch, one that took the ratio from around 105 down into the 40s and back up into the high 60s, all within roughly a year, things have settled into a range that, at least for the moment, looks closer to historically typical than the extremes on either side of that journey. What 67 means in concrete terms for 100 ounces of silver. Let's make this tangible, since the whole point of understanding the ratio is being able to translate it into something concrete about what you actually own. If you're holding 100 ounces of silver, and silver is trading around $65 an ounce, that collection represents roughly $6,500 in value. Now, using the current ratio of 67, we can ask a different question. How much gold would that same $6,500 worth of silver convert into if you were to trade it for gold at today's ratio? Divide 100 ounces of silver by a ratio of 67, and you get approximately 1.49 ounces of gold. I want to be careful here about what this comparison is and isn't useful for. This isn't a suggestion that you should trade silver for gold, or vice versa. It's simply a way of making the abstract ratio concrete. At today's specific pricing, your 100 ounces of silver and roughly 1.5 ounces of gold represent approximately the same dollar value. Some investors who actively trade between the two metals do use the ratio as one input in deciding when to make that kind of swap, generally with the idea of accumulating more ounces of whichever metal looks relatively cheaper by historical standards, and then swapping back if the ratio moves the other direction later. That's a specific active strategy with its own risks, and it's not something this video is recommending. It's simply useful to understand the mechanics of what the ratio actually represents for someone holding a real, specific quantity of one of these metals. A structural factor worth knowing about, the silver supply deficit. There's one more piece of context that gets cited frequently in discussions of the gold-silver ratio and where it might be headed, and it's worth mentioning because it's a structural supply-side factor rather than a short-term price movement. According to the Silver Institute, 2026 marks the 6th consecutive year of an annual global silver supply deficit, meaning demand for silver has outpaced newly mined and recycled supply for 6 years running. This is frequently cited by analysts as a structural factor that's different in nature from the kind of day-to-day news events that move prices in the short term, things like jobs reports or geopolitical headlines. A persistent supply deficit reflects a longer-running imbalance between how much silver the world is using across jewelry, investment demand, and a growing set of industrial applications like electronics and solar panel manufacturing, and how much new silver is actually being produced each year. I want to be careful about how this fact gets used because it's exactly the kind of data point that often gets stretched into a prediction. A supply deficit is a real, documented, structural condition. What it means for where the gold-silver ratio, or either metal's price, goes from here is a separate question, one that involves a lot of other variables, including how demand itself might shift, how mining production might respond over time, and how investor behavior around both metals evolves. It's a piece of context worth knowing, not a forecast in itself. Why the ratio moves the way it does It's worth taking a moment to explain why gold and silver don't simply move in lockstep with each other, since that's the entire reason a ratio between them exists as something worth tracking in the first place. Gold functions overwhelmingly as a monetary and safe haven asset. Central banks hold it as a reserve asset, and investors turn to it heavily during periods of economic or geopolitical uncertainty, largely independent of how much gold gets used in manufacturing or industry, which is a comparatively small share of overall demand. Silver carries some of that same safe haven characteristic, but it also has a substantial industrial demand component used in electronics, solar panel production, and a range of other manufacturing processes. That dual identity means silver's price responds to a different, broader mix of economic conditions than gold's does, which is exactly why the ratio between the two doesn't stay fixed, and instead moves as economic and market conditions shift. This also explains why the ratio tends to compress, meaning silver gains relative to gold during periods of strong industrial demand or renewed investor enthusiasm, specifically for silver, the way we saw dramatically through 2025, and it explains why the ratio tends to widen, meaning gold gains relative to silver during periods of acute financial stress, when investors are reaching specifically for the most traditional, purely monetary safe haven asset, the way we saw during the sharp spike in early 2020. What the ratio can and can't tell you, I want to close this out with something that matters more than any individual number we've discussed today: what this ratio is actually useful for, and where its usefulness ends. The gold-silver ratio is a genuinely useful piece of historical and comparative context. It tells you, at a glance, how the market is currently pricing silver relative to gold, and it lets you place that relationship against a long historical backdrop to get a sense of whether today's relationship looks typical or unusual by past standards. That's real, legitimate information. And understanding it gives you a more informed picture of your own holdings than looking at either metal's price in isolation. What it can't reliably do is predict what happens next. The ratio can remain at elevated or depressed levels for extended periods, sometimes for years, without reverting back toward its historical average on any predictable timeline. Both metals can also fall in price together, even while the ratio itself continues to favor one over the other. And past patterns, including the kind of historical averages and thresholds we've discussed throughout this video, describe what has happened, not what will happen. The ratio is one input among many that some investors weigh alongside their own goals, their own risk tolerance, and the broader economic environment. It isn't, on its own, a signal that tells anyone what action to take. Bringing it together, let's pull the full picture together. As of early to mid-August 2026, the gold-silver ratio sits at approximately 67, confirmed consistently across multiple pricing sources in the 66.9 to 67.1 range. That reading sits modestly above the long-run historical average of 60.5 calculated from annual data since 1971, but it remains well below the roughly 80 threshold that's historically been associated with the more extreme end of silver's relative undervaluation, and far from either the 52-week range's extremes of 46.3 and 88.9, or the truly outlier historical readings, like the spike above 120 in early 2020 or the low near 31 in 2011. Getting to today's reading involved an extraordinarily volatile path through 2025 and into 2026, with the ratio compressing from around 105 in April of 2025, down into the mid-40s at silver's early 2026 peak, and back up into today's high 60s range as both metals pulled back from their highs. For someone holding 100 ounces of silver, today's ratio translates to a value roughly equivalent to 1.5 ounces of gold, a concrete way of understanding what the abstract number actually represents. And underlying all of this sits a structural factor worth knowing: a sixth consecutive annual global silver supply deficit, a longer-running condition separate from any single day's price movement. None of this tells you what to do with your own silver holdings. What it does is give you an accurate, properly contextualized understanding of where this often cited ratio actually stands right now, how it got there, and what it has and hasn't historically signaled, so that if you do see this number referenced elsewhere, in another video, an article, or conversation with a dealer, you have the historical grounding to evaluate what's actually being said, rather than taking any single interpretation at face value. If you're the kind of investor who finds this kind of historical and structural context useful alongside your own decision-making process, that's exactly the kind of thing a conversation with a licensed financial advisor can help you weigh against your specific goals and circumstances. This video is meant to leave you better informed, not to tell you what your next move should be. Thanks for spending this time with Silver Dollar Retirement. If you'd like a deeper look at any piece of this, how the ratio has behaved around past recessions, or a closer look at that silver supply deficit, and what's actually driving it, let me know in the comments and I'll cover it in an upcoming video. Disclaimer: This video is for general educational and informational purposes only and does not constitute financial or investment advice. The gold-silver ratio and all prices referenced in this video are tied to specific dates noted throughout and are subject to change, sometimes rapidly. Historical patterns discussed in this video describe past market behavior and are not predictions or guarantees of future performance. This video does not recommend buying, selling, holding, or trading any asset. Please consult a licensed financial advisor before making any investment decisions.